Welcome to Clarity, a podcast powered by the Thomson Reuters Institute. I'm Zach Warren, the Institute's Technology and Innovation Insights lead. In each episode, we dive deep into a single question from decision makers and thought leaders from legal, corporate, tax accounting and audit, and government communities. In today's episode, we discuss the big question: what transformative changes could occur if fraud losses were reported accurately and comprehensively? These days, particularly in the financial services sector, fraud is more pervasive than you might believe. But even then, not all fraud is visible, particularly in an under-budgeted fraud function. Sometimes an organization knows fraud has occurred, but doesn't know its provenance or how it occurred. And other times, fraud can go unreported altogether. And when this occurs, the losses can mount quickly. So what changes can be made to gain more visibility into those fraud losses? And what does the future look like with those changes? Today, TRI's Rabihah Butler speaks with Frye, founder and CEO of Lucid Consulting, about the future of fraud detection.
Welcome to today's insightful episode of Clarity presented by Thomson Reuters Institute. Today we address a very important question. What transformative changes could occur if fraud losses were reported accurately and comprehensively? We are honored to have Frye of Lucid Consulting with us as he provides an in-depth analysis of the types of fraud that often evade detection and explores the reasons behind their underreporting. Prepare for a thought provoking discussion and meticulous analysis that aim to shed light on ways to effectively manage and mitigate losses. This is an opportunity to critically assess current practices and consider strategies that could redefine the industry. Join us as we examine these critical issues, offering insights that could lead to increased transparency and accountability within the industry. Let's commence with this enlightening journey. Aaron, you can give us a little bit of your background and a little bit of background on your company.
Thank you. Appreciate it. So again, my name is Frye. I'm the founder CEO of Lucid Consulting. We specialize in fraud risk management consulting services, as well as we offer sales consulting related to solution providers for fraud and payments risk and transaction monitoring. A little bit of background about my industry experience before launching my firm. I started my career working in risk management at GE Capital. I did a 2-year rotational program there when I graduated. And shortly after leaving the credit side of risk management, I joined their fraud risk program. So I was doing fraud reporting and velocity strategy there for them. A couple years later, I joined SunTrust Bank before they merged with BB&T to become Truist. I was doing fraud governance over their strategy and operations department. After a couple of years there, I joined BBVA USA. There, I was the service owner for all fraud vendors. Then PNC Bank acquired BBVA USA. So then I went with the acquisition of PNC Bank, doing fraud governance over their strategy department. And then in my final role in the industry, I joined a payment processor named Swivel. There, I was doing governance and payments risk compliance for their products there. And so, which we owned AML and fraud under the compliance function. And I decided to take the industry experience with a couple of my partners and say, hey, let's try to become the consultants we wish we received in the industry. And that's how we started Lucid Consulting.
Okay, great. So the short way of saying that is you are a brilliant fraud specialist, and I'm so glad to have you here. And I think this will be coming out just before your session at the Association of Fraud Examiners in June in Tennessee, right?
Yes, there I will be a speaker with my own session talking about layering fraud controls at different entry channel points for institutions. So very excited for that as well.
Okay, well, great. Well, let's start here. We're talking about the transformative changes that would occur if fraud losses were reported accurately and comprehensively. So, this is a bit of a loaded question. Where did the question come from?
I mean, as a whole, I realized with my industry experience, there's really kind of two different issues that are commingled into one. One is a misclassification of fraud losses occurs in a lot of institutions. I've seen it directly in the industry. I've seen it with clients. And also when I realized one day in the industry that they were not on financial statements, that was eye-opening for me in my career. First example is when I was working at one of my companies. we asked the credit leaders, like, hey, where are your fraud loss reporting? And of course, the credit risk leaders said, hey, we don't have fraud losses. Which at that point, I realized early in my career that everyone has to have some kind of fraud losses at some sort, especially in financial services. So we decided to dig through their credit loss reports, and we started finding very common language of can't find the customer, can't find the equipment. If you can't find those two elements, it's probably fraud. And when we brought that to their attention for the risk leaders, they realized, oh, we must have been misclassifying these internally. So we combed through more than 10 years of reports and started finding their official fraud losses and reporting and started developing fraud risk appetite. So just the fact that it was misclassified, the risk leaders just did not know how to combat it. They didn't know what the next steps were because internally they believed that there was no fraud. They all just classified as credit losses. And then also in the industry as well, I was doing a vendor return on investment analysis, taking a look at all the vendors' cost and looking at our fraud exposure or fraud loss avoidances versus our net losses. I mean, even with the spending amount being close to 15% of the total net losses, I still realize that's a very high amount of fraud for the amount of money that we're spending. And so at that point, I asked my manager, I said, hey, how are the board members and C suite okay with these numbers and fraud losses? And she said, they're probably not seeing it because they're not on financial statements. And I was like, there's no way. And so that actually prompted me to reach out to some former colleagues at other FIs. And I was like, hey, are your fraud losses on financial statements? And they were like, oh, no, accounting doesn't put them there as a line item. And I was like, holy cow, like this is the root problem of our industry completely. And I feel like until you have the right amount of attention, it's borderline impossible to go ahead and tackle the problem, especially from board members and C-suite. They divvy up the budget every year and they decide where the funds go.
So I know you gave a couple interesting examples, but where do you see, other than those two, fraud losses being reported? I mean, they have to go somewhere, right?
Yeah, so it's interesting because to your point, I asked accounting at one place. I said, "Hey, where are the fraud losses going for accounting purposes?" And what I quickly learned too, everyone does it differently because there's no regulations around it. So I've seen where some institutions will put fraud losses within an operational loss bucket. Some of them, if they're a credit product, they might put them in the credit loss bucket for expenses and losses. Some of them have, almost every FI has an acceptable loss bucket line item. It's kind of a general, like, hey, we don't know where to stick these losses, so we're going to stick in this bucket. And and at that point, you realize from an accounting perspective, it's a legal way to manipulate how you want your fraud losses to impact your financial statement. So you might say, hey, let's put these credit product losses to credit losses, and we'll just put some of these other ones to operations, and then put some in acceptable loss. Whoever kind of has the most space for the expectations of the closest to financial goals for a company is where they're sitting. And actually, even I had a former colleague. He said his company he used to work with, they called it a fraud expense, is where their losses went. So they called it essentially a cost of doing business as literally an expense item, and not actually telling the true story that it was losses on a financial statement,
So
which
they
I thought that
just
was very
spread it
interesting.
everywhere.
Yes, spread it everywhere. You can make it look the way you want internally for shareholders and stock prices benefits.
Well, with that being the reality, obviously something needs to change to get better visibility on fraud losses and allowing them to be accounted for. What do you think needs to change to get that visibility?
I think it has to start almost outside of the institutions, and that would be around legislation, whether it's at a federal level or a state level. Just to say, hey, if you're doing business in this sector or if you're doing business in this state, we must see fraud losses on financial statements for reporting purposes. Especially as fraud is catching more and more attention, especially with scams as well, which is a separate line item in discussion overall. I realize scam losses and fraud losses are very different. So I think it starts off at legislation at multiple levels. But then honestly, I think the insurance carriers, a lot of FIs have insurance on fraud losses to a certain degree. And those are usually private insurance companies. I mean, basically, an insurance company could literally say, hey, we could lower your premium, but you must put your fraud losses on a financial statement, or they keep raising premiums around fraud loss insurances. So there's a lot of opportunity there for Fed, state legislation, and insurance carriers. Plus, I think just overall making sure that everyone understands that there are fraud losses, even as a subcomponent, if you do put it in another bucket on a financial statement. Just say what part of your operational losses or credit losses were due to fraud, you know?
So you said something interesting, and before we go on, I wanted to kind of go into it a little bit. What is the difference between a fraud loss and a scam loss?
So it's funny because again, a lot of scams today are being classified as fraud internally, as fraud losses. But when a scam occurs, that means someone is the truthful account owner is authorizing the money movement to go to another account, whether it's for an investment or romance scams. Sometimes it's elder abuse, manipulation, or deception. And then fraud occurs is when, somebody takes account takeover action, or they're purposely being deceptive to try to get, chargebacks or get free returns on their products. So it's very different mentality to realize someone is pushing out this money on purpose for their own personal gain or interest, and then realize later on that they're never going to see their money back, versus somebody who is doing it on purpose or having a third party fraud situation where they've had account takeover or had access to an account to fraudulently know that they're not going to repay the loan or the credit, or give the funds back.
So it's almost like when we're talking about fraud, we're talking about the items where people think there are no victims per se, or that the company is the victim, not an individual, right?
Correct. Yes, absolutely.
Okay. So as we move on, what do you think would be the larger impact if we really change the way we tracked these fraud losses?
Oh goodness. Number one, fraud risk functions would finally receive, I would say, a proper budget. From industry experience, and it's the most common conversation across multiple industries, but fraud functions are usually under budgeted, understaffed, which means you got overworked with little resources to really combat the issues. I mean, honestly, I feel like if there was a real announcement that came from legislation, that would say, hey, fraud losses are now on financial statements, there might be a nationwide happy hour for everyone working in fraud risk functions to realize that they're going to finally get the attention they deserve, for how hard they work, especially with the sometimes limited visibility, for how hard they're working. But on a serious note, outside of the budget, I think it would actually make companies assess their fraud risk appetites, to determine what is their tolerance for fraud, because you have to have some fraud related losses to do business. I mean, if you stop all fraud, you're going to have a horrible customer experience, and essentially your business might not exist. So, but I think the fraud risk appetites would be enhanced to a way that makes sense and are manageable. And at that point, you're able to measure it too from a financial investment about, if we're spending X amount, we should only have X amount of losses. It's kind of that simple. To date, I've realized almost every financial service company has different fraud risk appetite measures. I've seen some do it versus volume of transactions that are fraud. So I've had some of them do your net losses compared to your net income. I've had some of it look at your fraud losses relative to your operational losses or your credit losses. And then you got some who just literally don't have an appetite. The goal is just try to manage it, without any real measurable financials against losses internally. So again, I think the fraud risk appetite structure would come, and that would help determine the increase of budget expected, to be able to reduce fraud losses or be able to manage them. That makes sense for their financial statements and situation.
So in the current regulatory environment, are there any or is there any legislation that is kind of waiting in the wings to be pushed forward on fraud, or are we still too early to discuss that?
Sadly, I think we're still too early to discuss. I know scams is always the most popular conversation right now. I've had contacts who reached out to people at Thomson, and there's about scams. I mean, if you looked overseas in Europe, the UK recently decided that for scam losses, it might be a shared loss between the victim and the FI as well. So, trying to figure out that percentage of liability for the loss, is the thing here that's that they're trying to really iron out properly in America, which is tough because I mean I've seen situations where some FIs are reaching out to the account holder and they're like, hey, we don't believe this is a good idea to send the money to this person or this entity. We have a lot of reason to believe that this is likely fraudulent and you're being scammed. And if the individual, keeps pushing on saying, "Hey, no, I believe this is a investment that's going to change my life," or "I believe this person I've never met is, is my future soulmate or my next soulmate," it's unfortunate that those situations are going to be let out to be losses. And if they get reported, sometimes people, sadly, what we know from scam losses and some fraud losses is that's based on what's reported. There are people who there's probably a lot more out there that's just not being reported out of personal embarrassment, unfortunately. So you still got to figure out who's going to own these losses. And a lot of FIs and companies do not want to take those losses. They are today, but that might change in the next year or two. Just depends on where legislation goes and priorities go. But hopefully, fraud losses do become, again, like I think it starts off with just being legally bound to be on a financial statement as a whole. It has to get the public record for your shareholders, for your board and C-suite, to really look at that line item to move the needle the right direction.
So, we're talking about properly tracking fraud and properly understanding it. How do you feel current fraud risk leaders would react to changes being implemented where we are tracking actual fraud?
Oh, if fraud risk leaders today, there would be really two categories of fraud risk leaders today. If they announce, say, June 30th, hey, starting in third quarter this year, we're going to have fraud losses on financial statements. And on top of that, we're going to date it back. I would personally recommend that we date it back to like the last 5 to 10 years, even. Actually, probably 10 years, just because you get a lens of pre-COVID a little better versus where we are today. Uh, you're going to have some fraud risk leaders that are going to be jumping for joy because they know that they've been screaming at the top of the mountain internally and trying to get their partners to say, "Hey, we need budget, we need help," and they know the help is coming. Then you're going to have other fraud risk leaders that are going to probably exit out of fraud risk management expeditiously. I'd really think that, if it's a fraud risk leader who owns fraud, but it's a component of their risk function. So, for example, if they own compliance, AML, BSA, cybersecurity, and fraud is a part of their role, I believe some of those leaders may say, "Hey, I think we should hire somebody now to do just fraud." Where and then you got other ones who might have a fraud program and they might know internally, or they might know in the back of their mind their track record historically where they've gone to different FIs as fraud leaders. There's been a high amount of losses, and I think at that point they're going to realize there's going to be a public paper trail of losses that were extremely high on their point of, from their accountability for leadership. And I think some of them are going to either get to another risk function, or depending on where they are in their career, they may just call it a day and retire if they're able to. So it's definitely going to send the two different directions, though, for fraud risk leadership.
So, in a lot of organizations, we're noticing that fraud and AML departments, or the FRAML departments as they call, and by the way, I hate that term, but they're combined. And so they're using that risk kind of hodgepodge conglomeration to track both. Do you think that's an effective means of tracking fraud?
Effective depends on the leadership. I'm generally against the Framel approach, having them under the same umbrella. I think the only way that approach could truly work is if the leadership understands that fraud and AML are not the same thing. They overlap in certain ways, but they're not the same. I mean, at the end of the day, AML is about keeping bad money from coming in, and fraud is about keeping good money from going out. It's a very different mentality. Plus, with AML, I mean, you have your laws and regulations that are very straightforward about what you must do to be with compliant for anti-money laundering. It's pretty straightforward. Fraud is a free for all. I do understand where they commingle, and of course, a perfect example is a synthetic ID opens an account. That is fraud, but then the money that's coming through it being washed is from drug money or other illegal activities that's then being sent out somewhere else to to fund other illegal businesses. That's where the overlap is, but at the end of the day, uh, fraud is still it's still fraud. It's not about the AML piece. It's the fact that someone a fake identity was able to open an account. It's not AML. It's truly fraud. So you take away the synthetic account being opened, then there's no AML issue right there. So that's why I feel like sometimes fraud is a little bit I wouldn't say more important, but it's so much more important to understand how to manage it effectively. And just in my own personal experience and from speaking to people around the industry, there's always usually an issue with fraud when another risk in general owns fraud losses, or owns the fraud risk program. I mean, if your title does not start with fraud, fraud is guaranteed to be your secondary focus simply because of your title of your role or the title of your function. But yeah, fraud and AML, I think they should be separate, but they should work very close, especially with cybersecurity as well, because they all overlap in different ways. But they should not really be completely commingled unless management truly understands how to manage them separately, side by side, which not many leaders in general, I believe, understand how to do those two things.
So, one of the basic things that we're talking about is after we develop this accurate and comprehensive program to track fraud, uh, what then becomes of these departments? Like, what changes? What's the ultimate outcome?
I think for one, there might be determining how this is going to impact their financials, their financial scoring overall for their stock prices and value overall. To realize, is fraud now being such a reputational risk combined with other risk factors to say, hey, this is the first time we're looking at this. How much is it going to impact our value over time? So I think that just really is. It's just going to be a phenomenal situation to start off there, so that they understand that there's now reputational risk being added now, and it's very public. I think reorgs will occur as well. I think a lot of structures will understand that roles and responsibilities will have to be very ironed out now. And I also think that every fraud risk program will now become centralized. Sometimes today they're decentralized, where operations might run in one part of the institution, governance might be in another one, and they're supposed to be working together, but we know that usually they're not talking as often if they are decentralized. So I think it would almost automatically make all fraud programs have to be centralized internally to make sure you get a better lens on that.
So, who needs to come to the table and really start the conversation for change to occur?
I would start off with a combination. I wouldn't even say who was the one to start. I think it's a joint effort between a lot of different agencies. One is, of course, federal legislators, state legislators, FinCEN, Financial Crime Enforcement Network for sure, because today they pretty much just say if you think it's fraud, file a SAR, suspicious activity report, and call it a day. I think even the accounting standards boards, whether it's for financial, SEC, government accounting standards boards, even international accounting standard boards, I think that even they've all got to come together and say, hey, should we start making sure that these are part of our best practices for accounting purposes? And then also, I think some of the biggest impact would also come from insurance carriers. I really believe the insurance companies really could be a pillar in this conversation with legislation, fencing, combined with different accounting boards to really say, hey, like we might not want to insure as much fraud anymore until these things are in place, whether it's from a program review, financial statements, publicity as well. So again, it's a joint effort from multiple agencies.
And do you think there's going to be a triggering event, or there needs to be a triggering event to get these people to the table?
Oh, I think I'm trying to think who would be the one to start to bring them all together. It would either have to be FIs or potentially, I think it may start after scam losses regulations really in place in America, because today scam losses are sometimes being commingled into fraud losses. And the volume of scam losses are just exponentially going through the roof. I mean, we've seen different reports online in general about different countries that are building whole warehouses to have a whole call center and scam center. And in certain countries, sadly, that's going to affect their GDP if you do stop these scam call centers. And so I think it's going to take a real joint effort. I think legislation, when they focus on scams first, it's going to be a domino effect into the fraud losses as well. And I think at that point, everyone's going to be coming together. And especially, honestly, I think solution providers are going to play a big role in this as well, because they have a lot of consortium data, but it's usually just their own consortium data for confirmed fraud losses. So I think when they come to the table and start making, I would say, a super consortium where they're now going to start sharing it, you got to figure out legislation to share that data, especially because things like privacy laws, like states like California and New York are just, they have some of the tightest legislation today around sharing any kind of information for privacy purposes. But I think, for fraud, they've got to figure out what that exception is for that data, because until everyone's talking state to state, legislations wise, fraud's going to continue to just keep going through the roof exponentially. And at that point too, there's still no budget. In general, there's a low budget to combat all of this. So yes, I think that's going to be the catalyst of it all.
So, what do you see happening over the next 12 to 18 months in the area of fraud reporting?
Ooh, 12 to 18 months. I mean, a lot of it, comes down to administration, office. And today, in general, the current administration, their reputation is around rolling back regulations in general. Is usually what happens when this party is in power for the US government. So I think it's going to almost delay the impact of it. And especially, that's just the norm of it, regardless of political views. It's just usually what happens is less legislation, which also means more money movement, which also means, and also just the fact that they're also shrinking the government size significantly today. A lot of people whose sole purpose was to help fight fraud or from a government federal level are reducing. So what's the priority going to be below that from a federal level? It's probably not going to be nearly as high either. So I think 12 to 18 months, I think it'll be more or less of the same. I think it's going to take either the right legislation by chance around scams, because again, fortunately, scams is going to always stay top priority, regardless of which administration is in office right now. And I think that's the good thing. But I think they've got to move a little bit faster. I think it's a little bit too slow right now, because we've been talking about scam legislation, for a couple of years, and we watched Europe go ahead and get their standards in place already. And it's how long does it really take? It's just who's going to prioritize it internally is the question.
So, as we're closing out, is there anything that you'd want our listeners to know or think of as we're closing, and talking about properly reporting fraud and properly tracking it?
I would say for the listeners, especially if you're in fraud risk management at all, use your voice internally to start understanding how are your fraud losses being reported outside of just your internal group. Because in general, sometimes fraud losses do get reclassified. And I mean, I'll just actually say, for example, I met with a gentleman at a conference recently, and he asked me, based on a certain product, he was like, should these fraud losses be classified as operational losses or credit losses? In my head, all I could think is it's a fraud loss, but my guidance recommendation was, depending on what control was the most faulty at the credit part or operational part to allow the fraud to occur, perhaps that's where it should fall a line for the loss reporting. But all I can think about is this is a fraud loss. I think that people should understand what their fraud losses look like reported wise internally for accounting, but also start to paint the picture to show if it was a line item today relatively to your other losses. That conversation and communication has to be presented to the right audience, whether it's line of business leaders, C-suite, board members, depending on the size of your FI, will determine the speed that you're able to report that. But I do believe that you must classify them as fraud and make sure it's being compared to other loss types internally to get the right visibility.
All right. Well, it was great talking to you today. And I definitely think we've all learned a lot about uh, the transformative changes that could occur if we did begin properly reporting our fraud losses.
Absolutely. I appreciate you having me here today. Thank you.
Thank you, Aaron and Rabihah, for your insights. Today, fraud functions may be under-resourced, but there is potential for real change. And if that occurs, I find it interesting that, as Aaron noted, stronger visibility into fraud losses will not only affect the bottom line, but the organization's people as well, with clarified reporting structures, roles, and responsibilities. The time to begin preparing for that potential future is now. Thank you as always for joining us for Clarity, powered by the Thomson Reuters Institute. You can follow or subscribe to this podcast on your favorite podcast platform, and don't forget to share with your colleagues and leave a 5-star review. For more data-driven analysis of today's professional services market and in-depth conversations with industry thought leaders, visit us online at thomsonreuters.com/institute or on LinkedIn under the Thomson Reuters Institute. Clarity is a production of Thomson Reuters, copyright Thomson Reuters 2025.